In this video, I'm going to share with you the most interesting charts released in the past week from Wall Street financial institutions to give you a deeper understanding of today's US market. The first chart shows you that the S&P 500 sell-off has been sharper than the average correction in the past 75 years. The x-axis on the chart represent time in month before and after the market peak. So there's plus 12 month and minus 12 month. On the y-axis, it shows the index value from 70% to 120%, and 100% being today's market price. The orange line represent the S&P 500 index price action as of February 19th, 2025. The dark blue line represent average correction in the past 75 years. The light blue line represents average bear market in the past 75 years. The blue shaded area represents 10th and 90th percentile across corrections. And as you can see, our orange line dipped below the 10th percentile in the past 75 years, marking this correction actually the 6th fastest correction in the past 75 years, because we saw a 10% drop in S&P 500 in just 22 days. And this chart shows you that S&P 500 has experienced a median drawdown this year already. The y-axis represent the drawdown in percentage, ranging from 0% to 50%. The x-axis represents the years from 1980 to 2030. And we're here, of course, 2025. And each bar represents the largest drawdown in a given year. The blue bar represents this year. So year to date, instead of 9%, we have actually already experienced a 10% drawdown, which is in line with the median 10% drawdown in the past 40 years. And this chart shows you Tesla has already declined by 50% from its 52-week high. The x-axis represent the list of companies in Magnificent Seven, and the y-axis shows you the percentage return from each, or percentage drawdown from each company's 52-week high, from 0% to minus 60%. Tesla is already down 50% from its past year high, while the other component of the Magnificent Seven are around 17% to 20%. It shows us how the market is pessimistic about Tesla, especially after Elon Musk being so heavily involved in the politics. And this chart shows you the average S&P 500 return following 35 corrections of 10% or more since the year 1950. The x-axis represents the investment horizon after a correction, 1 month, 3 months, 6 months, and 12 months after a correction. A correction is a market drawdown of more than 10%. The y-axis shows you the average return in percentage from minus 2% to plus 14%. The dark blue represents periods without a recession following the correction. The light blue represents period with a recession following or 12 months after the correction. So as you can see, after the 10% correction since 1950, we should if this correction has no recession following it within 12 months, we should expect on average 12% return 12 months later. This chart shows you US equities is trading near the smallest risk premium since 2002. The y-axis represent the yield in basis points ranging from minus 200 or minus 2% to plus 12%. And the x-axis represent the time from 1990 to 2025. The line represent the yield gap over time, and it's comparing the S&P 500 yield, which is earnings per share divided by price per share, or E divided by P, inverse of PE ratio. Okay, to compare that yield against the 10-year Treasury yield, which is the risk-free yield. And as we can see, this thing is getting pretty small. It's pretty much telling us that in today's day and age, because of the COVID causing inflation, and because of the inflation fighting policy implemented by Federal Reserve, resulting in a pretty high 10-year bond yield, it's making today's fixed income investment pretty attractive in comparison to the stock market investment. This chart shows you the Magnificent Seven is currently trading at their lowest valuation premium to the rest of the S&P 500 since 2017. The y-axis on the left represents the absolute forward P/E ratio of Magnificent Seven, and which corresponds to the dark blue line on the chart. And look at the left-hand side. The right-hand side y-axis represents the premium of the Magnificent Seven versus S&P 493. So pretty much rest of the S&P 500. It's comparing the percentage difference in PE, forward PE between Mag 7 and rest of the S&P. This chart shows how Magnificent Seven companies will spend 2 times as much on CapEx in 2025 compared with the year ChatGPT come out, right? So the y-axis represent CapEx in billions of dollars, ranging from $0 to $400 billion. The x-axis represents a year from 2015 to 2026. 2025 and 2026 data are forecasts for CapEx. Each bar represents the CapEx spending for each year for Mag 7. And ChatGPT came out end of 2022, November 2022. So we can say 2023 is the year of ChatGPT. And ChatGPT saw the largest success in human history for AI, right? So the CapEx is expected to be double in 2025 compared to 2023, the year of ChatGPT. So it's telling us that we are in a technology race. The Mag 7 is in a technology race. With heavy investment, Mag 7 are positioning themselves for potential high growth in the future.